Philip Fisher, The Hunt for Extraordinary Businesses. Philip Fisher was not just an investor, he was a detective of business greatness. While others were busy staring at stock tickers, Fisher was out in the real world, visiting factories, talking to employees, questioning suppliers, and pushing deeper than any balance sheet could ever reveal. He believed that extraordinary investment opportunities are hidden beneath the surface, discovered not in numbers alone but in the stories and people behind the business. His approach became known as the Scuttlebutt Method, a powerful technique that has inspired generations of investors, including Warren Buffett himself. But before Fisher became one of the pioneers of growth investing, his life was shaped by curiosity, discipline, and an obsession with understanding what makes a company truly great. Born in 1907, Fisher entered the world of finance at a time when the stock market was recovering from the Great Depression's destruction. The typical investor looked only at financial statements and saw businesses through the narrow lens of profit and loss. Fisher rejected this mindset from the beginning. He believed that future growth, not past performance, was the secret to enormous long-term wealth creation. This simple yet revolutionary belief laid the foundation for his investment philosophy: find companies that will grow for decades, not just years. This idea led him to a question that would define his career: what separates average companies from great ones? Fisher argued that great companies possess characteristics invisible to traditional metrics. A firm might have a strong balance sheet, but if innovation was dying internally, its future would collapse. Conversely, a business with a modest present could explode in value if led by visionary management and driven by industry-changing ideas. In 1958, he published his groundbreaking book, Common Stocks and Uncommon Profits, which introduced 15 qualitative points for finding extraordinary companies. These principles were not mathematical formulas, they were investigative tools. Among them were questions like: does the company have products or services with potential to increase sales for many years ahead? Does management have a long-term vision, not just quarterly goals? How strong is the company's research and development program? What is the company's relationship with employees and customers? These questions guide an investor far beyond financial statements and into the true DNA of a business. Fisher believed that qualitative insight drives outsized returns, if you're willing to do the work. And his work was anything but ordinary. He would speak to former employees, competitors, distributors, anyone with insight into how the company operated. He walked factory floors. He observed corporate culture firsthand. These real-world insights helped him uncover opportunities most investors overlooked. But Fisher also understood the need for faith and patience. When he found a great company, he didn't trade frequently. Instead, he held on, sometimes for decades, allowing compounding to do its magic. The big money, Fisher famously said, is not in the buying or the selling, but in the waiting. One of his most legendary investments proves this lesson. Fisher invested in Motorola long before it became a global technology powerhouse. He saw early signs of innovation, disciplined leadership, and relentless ambition. While others hesitated, Fisher committed, and held for nearly his entire career, turning a single investment into a fortune. Many investors today chase fast trades and short-term wins. But Fisher's life stands as a powerful reminder: the greatest returns require patience, conviction, and deep understanding. His philosophy draws a clear line between two types of investors: the ticker watcher who reacts to noise and hype, and the business analyst who studies fundamentals that truly matter. Fisher always chose the second path. And his results spoke for themselves. By the 1960s, he became one of the most respected and mysterious figures in finance. Media attention didn't interest him. Public fame didn't motivate him. What mattered was discovering excellence and partnering with it for the long haul. His clients trusted him with their fortunes because he never gambled, he investigated. And as he grew older, his ideas deeply influenced another legendary figure, Warren Buffett. Buffett openly declared that Fisher's insights reshaped his investing style. He combined Benjamin Graham's margin of safety value investing with Fisher's qualitative growth philosophy, creating his own powerful hybrid approach. In simple terms, Graham taught Buffett how to buy a wonderful bargain. Fisher taught him how to recognize a wonderful business. Today, Silicon Valley's venture capital ecosystem, constantly searching for companies that will dominate the future, is built on Fisher's foundations. His scuttlebutt approach remains the gold standard for evaluating innovation, leadership quality, culture, and future growth potential. But Fisher's wisdom delivers another important message: great businesses are rare. Finding one requires curiosity, skepticism, courage, and a willingness to dig deeper than the average investor ever will. In the next chapter, we will explore Fisher's iconic Scuttlebutt Method, how it works, why it works, and how ordinary investors can use it to identify extraordinary opportunities in today's fast-changing world. The Scuttlebutt Method, digging for hidden truths behind great businesses. Philip Fisher's legacy rests on one of the most influential investigative strategies in investment history, the Scuttlebutt Method. While many investors rely on neatly packaged research and financial summaries, Fisher insisted that the truth about a company lies in places most analysts never bother to check. Scuttlebutt is more than research, it is detective work. It means gathering every scrap of information, uncovering insights buried beneath layers of public marketing and investor relations gloss. Fisher believed that competitive advantage must be visible in the eyes of those closest to a business: employees, customers, suppliers, distributors, former workers, even rival companies. If these insiders see innovation, integrity, and long-term direction, then the investor has found something rare. But if those closest to the company express confusion, distrust, or doubt, then it doesn't matter what the financial statements say, a disaster may be brewing. The Scuttlebutt Method begins with curiosity. Fisher encouraged investors to question everything. What is the company's internal culture truly like? Are employees motivated or frustrated? Do customers keep coming back? Are suppliers eager to expand the partnership or negotiating aggressively because they see the business declining? While financial statements tell the story of what already happened, Scuttlebutt reveals what is going to happen. Fisher emphasized that research and development, R&D, is the soul of future growth. If a company's future depends on innovation, investors must understand how deeply those innovations are prioritized internally. It is one thing for a company to claim that it values innovation, it is another for employees to actually live it daily. Fisher would not invest $1 before discovering whether the company had the capability and the hunger to stay ahead of competition for decades. Another major pillar of the method is analyzing the quality of management, something no formula can capture. Fisher argued that a great business requires ethical leadership that makes decisions not to maximize next quarter's earnings but to secure long-term dominance. Management should communicate clearly with shareholders, acknowledge mistakes openly, and maintain disciplined capital allocation. Leaders who chase short-lived hype or attempt to artificially inflate numbers could destroy a business. Because Fisher knew that arrogance, dishonesty, and complacency are silent killers of companies. But Scuttlebutt has another function, filtering out what Fisher called the one-decision disaster. Many investors fall blindly in love with a company's current success. They stop questioning. They assume that the past predicts the future. Fisher warned that every great company must constantly defend its greatness. The moment innovation stops, decline begins. Through boots-on-the-ground research, Fisher could detect early warnings that the public could not. When a business became bureaucratic or self-satisfied, Fisher walked away, long before the stock crashed. His approach was not only a method for finding winners but also avoiding catastrophic losses. However, the Scuttlebutt Method demands immense effort, and Fisher openly acknowledged that few investors had the discipline for it. Many prefer quick answers, easy metrics, and superficial analysis. Fisher believed that investors who rely solely on surface-level information fall into a dangerous trap. They own a stock without truly knowing what they own. That ignorance becomes painfully obvious during market downturns. When negative headlines hit, fearful investors panic and sell. But when you understand a company deeply, its leadership, strategic advantages, culture, and innovation pipeline, you can remain calm. You can hold with confidence because you know the true value others are missing. Fisher transformed research from a chore into a competitive weapon. Because knowledge is more than power, it is protection. But Fisher also warned that even the Scuttlebutt Method has limitations. Rumors can be misleading. Competitors may exaggerate the truth. Employees may speak emotionally rather than logically. Therefore, Fisher demanded cross-confirmation. A single negative comment meant nothing. A consistent pattern of concerns meant everything. Likewise, widespread praise from independent sources signaled exceptional strength. Carefully pieced together, these insights revealed a company's long-term destiny. Fisher's disciplined mindset extended to diversification as well. He rejected the idea of owning dozens of companies, just to spread risk. Over-diversifying, he argued, prevents investors from truly understanding the businesses they own. His style, own a few great companies, and know them better than anyone. This belief transformed investing from speculation into partnership. When he invested, he treated himself not as a trader but as a co-owner in the company's mission and future. And that deeper involvement unlocked a completely different psychological outcome: patience. When investors know the quality of what they hold, short-term volatility becomes irrelevant. Fisher repeated this timeless truth: rapid trading and constant portfolio turnover are enemies of compounding. The real gains come from letting time and growth do the work. His famous quote perfectly captures this philosophy: if the job has been correctly done when a common stock is purchased, the time to sell it is almost never. To Fisher, selling a great business too early is one of the biggest mistakes investors make. Because when you sell a compounding machine, you don't just lose the current profits, you lose the unimaginable future built upon them. This is why Fisher devoted endless energy to identifying durable excellence. But perhaps the greatest beauty of the Scuttlebutt Method is that it remains accessible. Any investor, no matter how small, can ask questions, gather information, and study businesses closely. In fact, Fisher encouraged ordinary investors to leverage their personal insights. If someone works in a particular industry, they may understand its technological future better than Wall Street analysts. If someone is a passionate customer of a new product, that first-hand experience may be the earliest signal of a major market shift. Scuttlebutt empowers investors to use their daily lives as research opportunities. If every interaction with a business provides a clue, anyone can become a better investor. But to benefit from those clues, one must think long-term, ask difficult questions, and remain intellectually honest, principles Fisher lived by until his final days. As we move into the third and final part of this documentary journey, we will explore Fisher's lasting impact on modern investing, his massive influence on Warren Buffett and Silicon Valley, and how investors today can apply his timeless wisdom to build wealth instead of chasing trends. Philip Fisher didn't simply teach us how to invest in growth, he taught us how to identify greatness. And that ability, once mastered, changes everything. Legacy of a Visionary: How Philip Fisher Shapes Modern Investing. Philip Fisher's influence reaches far beyond his own investments. He reshaped the very definition of what it means to be a great investor. Before Fisher, the market saw growth companies as risky gambles, exciting but unpredictable. He changed that narrative forever. Fisher proved that when innovation and competitive advantage compound over time, growth can be the safest path to massive long-term wealth. His philosophy planted the seeds of an investment revolution. Warren Buffett famously called Fisher's book, Common Stocks and Uncommon Profits, life-changing. Buffett had long admired Benjamin Graham, but when he discovered Fisher, his approach evolved. From Graham, Buffett learned how to buy undervalued stocks. From Fisher, he learned how to buy exceptional companies, and hold them forever. It was Fisher who pushed Buffett away from buying merely cheap businesses and toward investing in elite companies like Coca-Cola, American Express, and Apple. Fisher transformed Buffett's strategy from bargain hunting into building an empire. And Buffett is not the only giant shaped by Fisher. In Silicon Valley, venture capitalists adopted Fisher's teachings long before they ever quoted him. Tech investors rely on evaluating visionary leadership, scalable innovation, and network effects, exactly what Fisher advocated decades earlier. Every unicorn company today, Apple, Google, Amazon, Tesla, owes a philosophical debt to Fisher's belief that transformative ideas create transformative returns. Fisher lived by another principle that still feels radical: introversion is not a weakness. He avoided the spotlight, rarely granted interviews, and valued quiet thinking over loud promotion. Many see Wall Street as an arena of extroverts, but Fisher proved that the most powerful insights come from reflection and deep research, not from noise. His work ethic showed that the best investment decisions are rarely obvious, they are painstakingly uncovered. Another essential part of Fisher's legacy is his emphasis on character. He believed that ethical leadership was a company's most undervalued asset. A firm could have great products and strong sales, but if leadership lacked integrity, Fisher wanted no part of it. He said integrity cannot be measured quarterly, it becomes visible only through years of action. That long-term lens is why Fisher's investments often seem strange to outsiders initially. He prioritized factors that others ignored: employee morale, customer loyalty, managerial vision, and commitment to research. These soft qualities turned out to be hard drivers of wealth. Fisher was one of the first investors to track customer obsession, decades before Jeff Bezos built Amazon around the same principle. Fisher knew that customers tell the truth the market isn't ready to hear. His approach goes beyond analysis, it demands empathy. Investors must understand people, incentives, and behaviors. Great investing is not just math, it is psychology. Fisher also shaped how investors think about selling. While most people obsess over the perfect moment to buy, Fisher taught that selling too early destroys more wealth than bad stock selection. True compounding requires endurance in the face of volatility. Fisher investors don't flinch when headlines scream panic. They trust the work they have done. They trust the businesses they own. And trust is a superpower when everyone else is fearful. Yet Fisher was far from overly optimistic. He recognized that not all growth is real growth. Many companies promise the future but never deliver. These story stocks are traps, businesses with hype instead of substance. Fisher warned that great ideas alone mean nothing without execution, discipline, and market dominance. Growth must be earned. One of Fisher's most powerful messages for today's investor is this: expertise is optional, curiosity is essential. You don't need a PhD in finance to apply his teachings. You need only the willingness to ask questions others overlook. The Scuttlebutt Method turns everyday experience into strategic insight. If a company offers terrible service, maybe its moat is weaker than investors assume. If employees consistently praise leadership, maybe innovation flows from trust and empowerment. If customers love a brand so much that they recommend it to friends, then that brand may become unstoppable. Fisher's curiosity-driven mindset allowed him to discover greatness long before Wall Street recognized it. That early insight is where the biggest gains lie. Investing early in a promising company is not luck, it is the reward for seeing the truth first. Fisher knew that greatness takes time to reveal itself. Markets often misjudge young companies because they demand immediate results. Fisher embraced delayed gratification. He knew that the market eventually rewards patience, but only those who stay long enough to receive the prize. His favorite holding period was effectively a lifetime. Fisher's investment career demonstrates that one extraordinary winner can overcome several losers. In his view, the purpose of research was to identify companies capable of exponential growth, not average performance. If he found a company capable of dominating its industry for decades, he would ignore short-term noise entirely. He understood compounding not just as a mathematical force, but as a philosophy of life. Trust the process. Trust the time. Trust the long term. Even after Fisher retired from public life, his impact continued through his son, Ken Fisher, who built Fisher Investments into one of the world's largest wealth management firms. But beyond family, Philip Fisher embedded his philosophy into the DNA of modern investment thought. Every investor who prioritizes product excellence, customer obsession, ethical leadership, and transformative growth is following Fisher's footsteps, even if they have never heard his name. Today, the Scuttlebutt Method is more accessible than ever. Social media, online communities, consumer reviews, and global transparency allow investors to gather information faster and more broadly than in Fisher's time. Yet very few take advantage of this power. Many still chase the latest fad, trusting stock tips over deep understanding. Fisher would urge them to slow down, think clearly, and know what they own. Because when you finally discover a company with unstoppable innovation and trustworthy leadership, you don't rush to trade, you commit. The final lesson Fisher leaves us with is this: wealth is created not by predicting the future, but by selecting the people and businesses who will build it. Fisher turned investing into a search for excellence. And those who continue that search today have the chance to capture extraordinary success. Philip Fisher didn't just teach how to make money. He taught how to believe in the future, and profit by being right. Philip Fisher showed us that true wealth isn't built by following the crowd, but by looking deeper, thinking independently, and investing in companies with the potential to shape the future. His scuttlebutt approach teaches us that every breakthrough business begins with a powerful idea, visionary leadership, and a loyal customer base. If Fisher's philosophy inspired you today and you want to continue learning from the greatest minds in investing, make sure you subscribe to the channel. Together, we'll keep uncovering the strategies that create generational wealth and transform ordinary investors into extraordinary achievers. Thank you for watching. Stay curious, stay patient, and stay invested. See you in the next episode.